Okay, before we begin the market outlook this week, for all our CFA candidates, this is a good place to reach you among all the other places that we reach you. Left menu, if you click on live sessions and click on office hours, you will get the screen that is showing up here. Level 1 office hours, this is if you have any questions. So for quant, one of the sessions are already done. Next session, July 26th at 2 p.m. Then you have 29th at 10 a.m. Any questions you have on quant, there's fixed income, derivatives, FSA, portfolio management, economics. Level 2 for August, there's sessions on quant, on fixed income, on derivatives, on FSA, portfolio management, and economics. For level 3, these are the ones that I'm doing. Our first session is Monday at 2 p.m. It's on capital market expectations and asset allocations. There's 2 sessions. Fixed income, we have 3 live sessions coming up. Derivatives and currency management, 3 live sessions coming up. And then we go into two and a half weeks, I think, of live AM exam sessions. These are really important. If you have your exam coming up, if you have any questions at all, show up to these sessions. Even if you don't have questions, show up to these sessions, because you may think you know something. And when somebody asks a question and it's answered, you may say, oh, I thought it was something else, and it's that. You may think you know something. You know, sometimes it's not the things we don't know that will get us in trouble on the exams. It's the things we think we know for sure that are wrong that'll get us in trouble on the exam. Okay, one more thing here. For the Applied Series subscribers, 3 videos went up last week. Understanding Banks Part 3 is up. That's interest rate risk. This week coming up is asset quality. And here we're looking at the type of assets on the balance sheet and what is the big thing a bank takes on with those assets. Credit risk. We're going to look at that. So part 4 is coming up this week, will be asset quality. For the portfolio management construction seminar series, part 1 is up for screens. Part 2, the buy and hold allocation we've done. Now we're going to do rules. Whenever we're going to do any kind of active investing, you need rules. With passive investing, you don't really need a lot of rules. You need a good allocation, but you don't really need a lot of rules. If you're going to actively invest, you need rules. So we're going to think about different categories of rules, and then we're going to put on a simple income trade. We're going to try a simple income trade. So that is coming up this week. In the futures section, there was equities and treasuries, and I put a new one up, the Treasury basis trade, which is a very popular relative value trade. That's because the Treasury futures are not a no arbitrage price. It does appear that there is arbitrage available in Treasury futures, but it's not arbitrage. It looks like arbitrage, but it's not. And the basis trade, the Treasury basis trade, explains that one. So 3 videos last week. One for understanding banks, 1 in the portfolio construction series, and 1 in the future series. The next ones that are showing up here, and I'm not sure when they're going to be done because there's so much for them. There's wheat, there's corn, and there's cattle that are showing up in this section. And at some point, copper is going to show up, but this really needs to be done with one of the copper miners at the same time. And we know what's coming up this week. So there's 2 new videos for sure next week, possibly 3. Okay, let's start with rates. And I think the rates story is soon to take a back seat. It's not the main story, I think, going forward. Money market rates and capital market rates over the last week, very well behaved. Money market rates are making room, as you can see, for a 25 basis point hike. When we get to the next screen, we'll see the probability is almost 100% on 25 basis points. I think most people agree, and I think most Fed officials would probably agree as well, that you've got 1, maybe 2 rate hikes left, and then I think they'll be on pause for a while because the inflation data has been promising. It is coming down. Yes, it's still positive. Prices are still going up, but they're going up at a lower and lower rate. So I think they're more willing to wait at this point, but it looks like 25 basis points is a done deal. I don't know that there'll be much market reaction on Wednesday when they announce 25, because the probabilities have made room for it and the money market rates have made room for it. It's pretty much all priced in at this point, priced into the curve at this point. So it'll be, what does he say in the press conference about how much more is left to go? Balance sheet runoff continues, 20.5 billion down to 7.515 trillion. This is going to take years to run off, and it is running off at such a slow pace that I don't think that this is any cause for concern in the markets at all. It has not been. It has not even been a topic of conversation. Some people have brought it up over the last year. Remember, now we still have the balance sheet running off, which acts as tightening, but at such a high level, I don't think that that it's restrictive in the least. Balance sheet down 22.4 billion with the SOMA down 20.5. That means you also had a drop in the balance sheet of almost 2 billion. Curves still inverted. The money, the capital, the 2 to the 10, 98 basis points, slightly deeper curve inversion this week. The Canadian 2 to 10 is negative 116. 382 days now, 269 for the 3-month to 10 year, so going on 9 months. 162 in Canada, 166 in the US. And looking at the 3-month forward, inversion of 151 basis points versus 135 last week. Money market funds, money is flowing back in, increased by 4.22 billion. Retail up 7.21, both in government and in prime. Institutions down 3. Prime is up, but government is down. And that is because they can probably just buy it themselves directly. A note that I read, I think was from JP Morgan, noted the outflows from money market funds and the inflows into bond funds, so that this money coming out here probably belonged to the capital market, found a home in the money market for a while, is now heading back out to the capital market. So it is going into bond funds. Or it's either disintermediating the mutual fund and just buying T-bills directly, or it's going into bond funds. The Fed is in 3 days. 2 o'clock, the announcement, but the real show is 2:30. I think everyone's expecting 25 basis points. Look at the probability here, 99.2%. There is a few holdouts for 0, but for the most part, 25 looks like a done deal. Money market rates have all made room for 25, but clearly made room for 25 basis points. The hole is there. The Fed raising 25 basis points I don't think would bother markets that much because they've already made room for it. It's already priced in. It's the press conference that'll be everything. The very next night, Thursday night, is Bank of Japan. There is an expectation that something will be said about yield curve control. I got a little something coming up about the yen shortly, so I'll leave it till there. PCE on Friday morning. That's in 5 days. It follows along the same trends as CPI. I don't expect PCE will say anything different than what CPI had said, but it'll say it in its own way. And the following Friday is the jobs report, which I think will be the primary thing to be looking at on a going forward basis. I think central bank watching is probably sort of the second most important thing now. Inflation, I think, is the second or third most important thing. And I think jobs are the most important thing. We had rate hikes. There is phase 1. Does phase 2 look like this, or does phase 2 look like this? And that is all going to depend on jobs. If jobs remain positive, if the economy is adding jobs each month, then aggregate incomes are going up. That is the total spending power of the economy. And if you give consumers money, they will go spend it. And if inflation continues to moderate and come down, and employment remains low and the economy is creating jobs, phase two is going to be that. But if we start seeing those numbers start to slip, as soon as you go negative, that means aggregate incomes are negative. That means aggregate demand is now dropping. Then, depending on the extent of that and where inflation happens to be, then you might get the rate cuts. So I think that if we're looking at, for phase one, it was all about central banks and inflation. For phase two, I think it's all going to be about jobs. And I think that our focus is probably going to shift more towards the health of the labor market and less about rates, because I think rates, yield volatility, I think is going to drop, and I think they'll be sort of well behaved at these levels. I don't think that you're going to see the 30, 40 basis point moves per day that we've seen over the last year every now and then. I think that's done. I think we'll have low yield volatility, and central bank watching will be about jobs more than about inflation. Going into December, the weight here peaking at 5.5, which is one rate hike, 63.6% probability that there is one rate hike left. 25% on 5.75, but the 6% is dropping back down. We can probably cancel off these guys here. We're somewhere in here with the weight of it being one rate hike to go. Effective federal funds rate is 5.08. Starting Thursday, it'll be 5.33. Reverse repo still well below 2 trillion, even though it's up 30 billion. It's still well below 2 trillion. Probably trend down into the end of the year as more supply comes into the T-bill market. The Treasury general account, not much to watch here anymore, increased by 428 million. That doesn't mean the issuance was only 428 million. Remember, there's money coming in and money going out all the time, but I don't know that it's exciting to watch anymore. Lags, they haven't changed either, but next week the lags will change because we are getting a rate hike, and as we go back through some of these lags, there will be some rate hikes back here as well. If we're looking at the effect on the yield curve, there is no lag. In fact, the yield curve leads rate hikes. So there is no lag on the yield curve, so it's not as if we have to wait for that particular yield curve to show up. Banks create their own internal curves. They usually have an asset curve and they have a liability curve. The liability curve is called their cost of funds. And if you look at most banks in their management of interest rate risk, look at the derivative use that they have, and look at their swaps, their interest rate swaps. It's not uncommon to see swaps going out for 10 years with very low fixed rates, so that they are not feeling it yet. But the incremental borrower will feel it based on where their asset curve is, where their interest rate income curve is, but their interest rate cost curve is still, I think, well behaved because of those swaps. So they're not quite feeling it yet. So we know that there are some lags in the system because of the use of the elevated use of derivatives. Real rates have all dropped. Break-even rates have all increased, and I think that if we have very low volatility in nominal rates and we keep seeing inflation coming down, these real rates will continue to drop. Still have a curve inversion between the 5 and the 10 here. Fed funds futures still bottoming out in November, 94.59, implying a rate of 5.41, which is in the middle of 5.25 to 5.5, which implies, well, kind of more upwards than the middle, which implies one rate hike. And going out to March, 94.27, which is 5.23, suggesting that maybe there's a rate cut sometime by the end of March. With another rate cut by the end of June, if we work on the Fed funds futures curve. For 23 through 24, looking at 1 month SOFR, negative 136 basis points implying five and a bit rate cuts. Last week was 123, the week before 123, 136 now. Let's look at TLT. TLT had a kind of week, sort of unchanged. Implied volatility is 0 at all time periods, 52 week, 26 and 13. TLT was up 0.43, SPY was up 0.65. I have made no changes to my TLT position. It just didn't have any real excitement. This was sort of nice during the week, and then it gave back. I have my puts still in place. No changes. Mortgage rates really pulled back 18 basis points, down to 6.78. The 10-year Treasury Thursday over Thursday was up 9 basis points. Mortgage rates down 18, so the spread has contracted 27 basis points. Didn't do much to help agency. Basically flat, down 0.3% annually, up 0.45. ABR continues to win, up another almost 5%. IYR basically unchanged over the course of the week. DLR up 1.6, PLD down 1.8, and from PLD, they had a great quarter overall. As you dig through their presentation, the one thing that jumps out is the turnover in their tenant base. It has been turnover's been increasing for about 3 quarters now. So there's higher turnover, but the guidance given was fairly solid, but it got punished. Pre-market was 130, 129 to 131 was the bid. There was a 130 print in there, and then sold all the way down to 119, and didn't seem to make a lot of sense to me. So I added some delta on that at 120 and change, and just shy of 120 as well. Sitting at just a little around 125 right now. I don't know why it sold off. I went through the presentation again, and the nearest I could figure was, well, seeing that higher turnover is probably what did it. Home builders did not have a good week overall. DHI down 2%, Lennar down almost 5%, Pulte over 5%, KB Homes 3.5%, Toll Brothers 5.75%, Hovnanian 8.72%. The volatility on this one is incredible. No options. What a shame. All that volatility and no options. It's just like a waste, right? It's like being a great cake maker and making cakes and simply just throwing them in the garbage and never eating them. Get some options on this one. XHB down 1.2, ITB down 2.38. Given that you had a nice pullback in mortgage rates over the week, and the National Association of Home Builders, the Housing Market Index expanded, went from 55 to 56. Mortgage applications were up. Existing home sales were down 3.3% because home sales inventory is being kept off the market. This probably was not pleasant. Building permits down 3.7 month over month. Housing starts down 8% month over month. But I think there's more going on with the earnings. Let's keep in mind, home builders have had an incredible run since the lows in October. And even if you never mind the rally from October to December 31st and just look at beginning of year, some of these are up 60, 70, 100% since the beginning of the year. They've had an incredible run. And they have, a nice backdrop to work against. Is we went into the rate hiking cycle with a shortage of housing to begin with, and the rate hike cycle was so fast that you have many homeowners who are simply just not putting their house on the market. I'll show you some interesting charts coming up of the drop in houses available simply because existing homeowners are saying, Why would I get out of my 3% mortgage just to get into a 6.5%, 7% mortgage? So home builders sort of have a clear highway right now, but they are feeling pressure. DHI reported, and I can see some weakness under the surface. However, I don't know that the home builders are in for any kind of major sell-off until the conditions, the economic conditions change. And that would be something that induces a whole bunch of supply to come onto the market, which would be lower rates. Lower rates would begin to hurt the home builders because they would start to get more competition from existing home sales. But right now, it's still the sweet spot for the home builders. DHI, DR Horton, lower return on equity and return on inventory, 24.3. This is year over year, 24.3 versus 35.1. Now, mind you, much lower leverage. So if you decompose ROE, and those CFA candidates out there, charter holders out there will understand the ROE decomposition. Leverage is one of the factors. If you reduce leverage, you can reduce return on equity. You can always get ROE higher by increasing leverage. So yes, lower leverage, higher cost of financing. Let's lower that leverage while you would expect a lower return on equity. Return on inventory 31.8 versus 41.7. Revenues year over year were up 11%. Home sales were up 8%, but earnings per share were down 16%. The earnings were $3.90 per share diluted. Let's have a look at 23 versus 2022. The first 9 months of 2023 versus 2022. EPS are down 21% to $9.39. Net income is down 23%. So when you have these two moving differently, it's either share issuance or share buyback. Net income is dropping 23, but EPS is only dropping 21 because of share buybacks. Revenues up 2%, closings up 1%. So you have quantity that is higher, but you have earnings that are lower. You have much lower return on equity, much lower return on inventory. So it's sort of mixed on that part. Being that this is their sweet spot, you would have liked to have seen them keep their margins fairly solid. But margins are decreasing as well. So we can't just blame the entire drop of return on equity with the lower leverage. Their margin per home is also dropping as well. Okay, this first chart shows the shift in the number of homes going up for sale between June 22 and June 23. 2022-2023. Red market saw a year-over-year decline in new listings, so the darker the red, the closer it is to negative 40%. Have a look at that. There's only a couple of markets where you actually had an increase in new listings. Next chart here, change in regional home price in May. This is the shift in home values between April 23 and May 23. And the darker the blue, the closer it is to a 1% increase month over month. Look at these regions. Only one biggest decline, biggest May decline was Austin, Texas. The rest is all blue. Next one here, shift in regional home price since their respective pandemic peak. With the more red it is, the deeper the drop from the peak. And if it's blue, it is no change from its peak. Look at all the blue. You have some places that are red, but for the most part, look at this big area in here. Down the most, Austin, Texas, 13.78%, which helps us explain this one. April to May, biggest decline is still Austin, Texas there. But this is what is holding up the home builders right now. If you had to sum it up in one chart, it's this one right here, is that they have very reduced supply and very reduced competition coming from existing home sales, that any drop in rates is incrementally going to add competition to the home builders. I don't think phase two of where we're headed is a drop in rates. I think it is higher for longer. I think a drop in rates will come when something breaks. That could be the labor market or it could be something else. But if that happens, then that's just bad for everyone. So as long as we have higher for longer and job growth, I think the home builders can continue to remain at these levels, maybe even hit new 52-week highs. Let's look at two currencies, the Canadian, the US CAD. I'll circle this event here. CPI, Canadian CPI came out. I put a question mark there because to me it seemed like the wrong move. Let's look at what CPI had to say here. Core inflation, negative 0.1. Just let that sink in for a minute. The forecast was for 0.5, negative 0.1. Core, month over month, is in deflation. I'm going to underline it again, core. Year over year came in at 3.2. The expectation was for 3.5. It was 3.7. That's a big drop. The inflation rate was 3.4, came in at 2.8. The expectation was 3, came in lower. The inflation rate month over month was forecast to be 0.3, came in at 0.1. That does not look like data that needs another interest rate hike. So that should have weakened the currency, and it did not. PPI, negative 0.6. The expectation was for negative 0.2. Raw materials price month over month down 1.5%. The forecast was for down 0.2%. And this is a big one, raw material prices. The forecast was for negative 14.7, came in negative 19.7 after coming in negative 18.2 the month before, negative 19.7. I think the only things that you could pick on is to say, well, the trimmed mean came in higher than expected. That is taking out those prices that have fallen the most and those prices that have risen the most, and looking at the middle, that's 3.7. That might give you a better read. PPI year over year came in at a drop of 5.5%. The expectation was for negative 8.3. So these two things. But is that enough to outweigh all these larger amounts, especially with core inflation month over month showing deflation? Maybe no change on the currency. I could have said, okay, well, the market is deciding what to do, but it immediately strengthened without hesitation and continued that trend for the next few days. I found that very puzzling. By the second day, by the time we were sitting down here, I'm thinking, what is going on in the world where, you have companies that seem to be doing okay getting punished, and the companies with the highest multiple not getting punished for missing. And you have such backwards movement in pricing. I don't understand what's going on in the world. And then, some rationality started to hit. But I was getting very frustrated with that, thinking, okay, I don't know what anybody else is looking at. But clearly, I'm no good at this anymore because I can't figure this out. Let's see what happens. I think Bank of Canada is likely on hold, given the current data, and again, and I've said this before, given the higher level of interest rate sensitivity of the Canadian household versus the American household, we are in a much more precarious position than the U.S. So I think the Bank of Canada has to be very delicate here. Bank of Japan is Thursday. It says 11 p.m., but that's sort of just a suggestion. I expect no changes to happen, and I expect further weakness on the yen. 141.72. It was down around 138 for a while. It was at 145 the week before. 2 weeks ago, 145 down to 138. We're sitting at 141. I think it might revisit the 145s. I don't think Ueda is going to make any moves till the fall. At least that is what he signaled at the ECB conference 3-4 weeks ago on the panel discussion with Powell. He was sort of indicating that he's not really looking at anything till the fall. So I don't think that he's going to do anything at this point or signal anything. I think he's going to play it very, very close to the chest. This over here was inflation data, and let's have a look at how they did. Inflation rate year over year, 3.3. The expectation was for 3.5. It came down. Core came in as forecast. And I'm curious about this. I'm going to have to do some digging on this one here. Inflation rate ex food and energy. Is that not core? They must have a different definition of core. Because in North America, both Canada and the US, core is inflation ex food and energy. This is 4.2, so they must be excluding something else in their core inflation rate. If anyone knows what it is, save me some time doing a deep dive on this and put it in the comments section so that we can all know what it is. But I saw those two things and I thought, are they not the same thing? Apparently they're not, because they're at different levels. Inflation rate month over month 0.2. This is not in inflation data, I think, that is going to push the Bank of Japan to do anything just now, especially with the inflation rate, the headline inflation rate year over year dropping, and core, and of course the other core coming in as expected. I don't think anything much is going to happen. Now here's an interesting puzzle. The Fed is Wednesday at 2 p.m. We're expecting a rate hike. The market's expecting a rate hike. Money markets have moved and said, here's a hole to fill for 25 basis points. The probabilities are 100%. It wouldn't hurt the market. Fed's probably going to go. What's going to happen to the US dollar? Let's say, and this is a good exercise for CFA candidates for the code and standards dealing with material non-public information. Let's say Tuesday night, you had somebody inside the FOMC that got a message to you that absolutely, certainly, Wednesday at 2, we are going 25 basis points. What's your move on the dollar? What would you do? If I had that information Tuesday night, I still wouldn't know what to do. The dollar could strengthen because rates went up, or it could weaken because the market thinks that, well, that's it. That's the last of it. So you have the press conference coming up. And if Powell is dovish in the press conference, the market will hear rate cuts. If Powell is hawkish in the press conference, the market will hear that's the end of our rate hikes. Powell doesn't have to say we're cutting rates. He just has to say, I think we're pretty much where we need to be, and the market will hear we're cutting rates at our next meeting. I don't know why they impute those words, but they always seem to hear different things than what he says, and he has to come back out later and say, I didn't say that. What's going to happen? I don't know. So if I were in possession of this information, you are right to say I have non-public information, but is it material? Is it material when having the information can't help you? It is a coin toss. What's going to happen to the US dollar? I bet you there would be more of a split on what's going to happen to the US dollar than there would be with rates. 99.9% agree that there's going to be a rate hike, but I'll bet you that 50% of the market thinks the dollar will strengthen, the other 50% think it'll weaken. So it can't possibly be material at that point. What are your thoughts on that? Let's spend some time here with some live cattle. Last week was interesting on the price action. You had it hit 186, and then it kind of hung out there for a while. Then you had a breakout, and up it went. There was a report due out July 20th at 3 p.m. from the USDA, which would have put it over here after the market closed. So this is the effect of the report. So this could not have been fundamentally driven. It was a breakout from what seemed like a level of resistance, which is more likely going to be a short squeeze that's going on. If you zoom out, look at a 10-year chart. Here is where we finished at the end of the week on the front month. This is the December contract, so this price here won't match this price here, but this is the front month. Record price in 25 years. I got a 10-year chart, but if you click on 25, you go all the way back. It's a record price. This is October 2014. This, by the way, was the last time I did this reversion trade where I went long hogs and short cattle. because the tendency of supply and demand reacting to price is extremely strong. I'm not going to say it's a law. I don't like the word law when it comes to social systems. There are strong tendencies. So the law of supply and demand, I think, is a strong tendency of supply and demand. And it works as follows. Price destroys demand and price induces greater supply. So the higher the price goes, the more it destroys demand and the more it induces supply. Ranchers will then start increasing the size of their herd, but it takes anywhere from 12 months to 24 months to put a cattle to slaughter, depending on how you're feeding them. So over time, supply starts hitting the market, and that's what happens is the price goes down because you did destroy demand on the way up, and it did induce greater supply. Well, look at where we are over here. So it is going to work on demand. Now, I'm a price insensitive buyer. I don't really look at price of things when I go buy stuff. I just buy it. But I myself cannot help noticing the price of beef. What I would normally pay $96 for is $228. $228 from 96, and I'm price insensitive, and I say, wow. So, what is everyone else doing? So as far as where supply is going to come from, watch dairy cows. There is a dairy steer cross 50-50 called beef on dairy that you can send your dairy cows to slaughter because they are beef cows as well. So given these elevated prices, I'm sure that there are some ranchers out there looking at that saying, why don't we send some of these out? So it will induce greater supply, and it will hurt demand in the grocery store. And if you hurt demand in the grocery store, that echoes all the way back through the supply channel to the slaughterhouse, which says, well, we have fewer orders for our output, so let's stop buying so much for our input. Let's get to the report, and we'll go to page 4 and we'll go to page 11. We'll look at two things here, which caused Friday's price action. Red meat production, June 23 is 4.55 billion pounds. If you look at it year over year, 4.73, it's down, and beef production is down 5%. You would think, well, that's supportive of prices. But you have to look at where it's come from. There's April, there's May, there's June. Notice, we're moving upwards. Yes, you're down 4% year over year, but June has expanded from May by more than what was forecasted. If we look at the steer slaughter average dress weight, what's called a wet carcass, it was below last year. So not only do you have a lower herd, but the weight per animal is lower as well. Well, now it is higher. So all of these little things incrementally are adding to maybe a realization that the price is simply just too high. The amount of cattle moved to feedlots increased more than expected as well. It was expected to drop, and it increased. This is what this means. You have cattle that are free roaming, so they eat the grass or whatever is in the fields. But that takes exercise, so they don't gain weight as much. But it is a better meat in the end. It's a better source of meat. You can send in the feedlots. Feedlots are these small enclosed places where the density is extremely high. Like you're talking like 100,000 head of cattle in 1 square mile. There are two things that you can't help but notice with these feedlots. Number one is the inhumanity of it, and number two is the smell, the sheer smell of it. You're near a feedlot, you will smell it. They're corn fed, which fattens them up really fast because, well, they don't move a lot. However, that stuff doesn't work well with their digestive system, so they're on heavy antibiotics as well. If you have more of them being sent to feedlots and fattening them up faster, you could get something that looks like that. Let's have a look at this report, page 4 and page 11. This is the USDA site. This is their calendar of data releases. A link is in the description box. Here's the 20th. There's livestock slaughter. Tells you it's 3 p.m. And 3 p.m. the next day, after the market closed on Friday, you got a cattle and cattle on feed report. There we learned that the cattle herd in the U.S. is the lowest it's been in 50 years. Let's have a look at the report. There's our table of contents. The first page looks like this. You have just sort of an abstract highlights of what you'll learn inside. Scroll down to the table of contents and you can go to whichever one you want. First one is commercial red meat production. And there's our first table. June 2023, let's look at beef, 2,344.9. The month before was 2,305, so it was higher in June than May, but lower than the previous June. The next two columns, you could just jump right to there. It gives you a nice view of the trend, the year over year, the month over month. I don't know if I call it a trend, but the comparison. June 2023 is a percentage of June 2022, 95%. But it's 101% of the production of May 2023. When we look at these numbers and we think about production being down by a certain amount, down 5% year over year because we're running 95%, is it because supply is down or is it because demand is dropping? That's the hard one to pull apart. So when you see that production is dropping, is it because orders are dropping and demand is dropping or because supply is contracting? Let's have a look at copper. This is a 2-year chart of copper, and Freeport reported earnings this week. And on the call, the CEO, which I call Deputy Dog, if you remember the cartoon of Deputy Dog and the way he talked, I want you to listen to Deputy Dog, find a cartoon on YouTube, listen to Deputy Dog, then I want you to go to the conference call, and when the CEO's talking, I want you to listen to him. He sounds like Deputy Dog. This is what he said. Fundamentals in global copper market remain positive. Global copper inventories remain remarkably low, lower than December 31st, 2022, he's saying. I think he meant that as well. Current demand for copper is much stronger than current economic data. Now, you got to take this with a grain of salt because the CEO is the Elon Musk of copper. Elon Musk has been promising full self-driving for 10 years, telling you it's just around the corner. This guy, every quarter going back for a number of years, has been saying the same thing about copper. Every quarter, he says copper demand is not reflected in the fundamentals. The price has to go up. It's a tight market. Inventories are. He says the same thing every time. So it's a matter of, well, is he saying it just to say it, or is it true this time? I don't know. So just take that with a grain of salt. He said all those things, but if you go back to the last quarter, he said the same things. Go back to the quarter before, he said the same thing. Go back 2 years and listen to a conference call. He said the same thing. So I don't know. He expects copper volumes in the second half of 2023 to be up 15% over the first half. Let's have a look at some selected slides from their presentation. This is slide 6 from the conference call presentation. I do encourage you to listen to the conference call if you are interested in copper or the copper miners. It's quite interesting. Current copper market commentary, and he says it better than I can, but I'll just I'm basically just reading to you what's here. Slowing global growth in manufacturing sector. However, the auto sector, EVs are growing rapidly. I will have something to say about that shortly. Copper-intensive expansion of renewables and supporting infrastructure. The problem we're seeing here is you're getting infrastructure projects that are being canceled I think there's three notable ones. They were all wind power ones being canceled because the costs were simply just too high at this point in time. So the costs are beginning to work against investment in infrastructure. China's copper consumption continues to grow despite property sector weakness from growth in EV and renewables. Supply challenges persist and notable low inventory levels. Forecast here, 2022, copper demand was 25 million tons, forecast to double by 2035. We're 2023 now, so over the next 12 years, forecast to double. And the mining capacity on the planet doesn't exist for that yet. So capacity is going to have to be expanded. And this is what he says here. Prices will need to rise to incentivize new supplies. A looming supply gap is expected. Intensity of copper use in electrification is rising. Low carbon technologies driving massive growth in metals demands, and renewable growth from 10% to 60% of power under 2050 net zero. If we scroll down to here, we get this is for Freeport now. This is their costs for copper here. This is an interesting chart. Unit net cash costs per pound of copper. North America, unit net cash cost $2.56. Site production and delivery $2.90. Byproduct credits 46 cents. Treatment charges you get to $2.56. South America you get to $2.33. Indonesia, look what's going on here. Isn't that interesting? $1.70. Significantly lower on their site production and delivery, but look at those byproduct credits, $2.39. Even after treatment charges, royalties, and export duties, you're negative 6 cents. Negative 6 cents. That is your unit net cash cost, negative 6 cents. Isn't that incredible? And this is 2023 estimated sales by regions. Look at Indonesia here. Is the biggest of the three. And the best cost profile by far of the three. Let's look at some sensitivity. So when we're looking at mining companies, they'll fluctuate with the price of their output. On a day-to-day basis, they'll fluctuate. So if we see in the futures market, if we see that copper is down in the futures market, we expect Freeport will open up down. Look at the sensitivity here to changing prices in copper. Plus or minus 10 cents is 425 million on EBITDA. So if copper goes up 10 cents, they add 425 million. They add 335 million to their cash flow. So that's why copper is a big output from Freeport, and that's why they tend to just bounce around with the price of the commodity. So if we expect copper prices to rise significantly in the future because of this growing need from electrification and infrastructure to greener energy, Freeport will go along for the ride. We can see exactly how much it will go along for. If prices increase 20 cents in copper next week, their cost per unit does not increase. It stays the same. The cost per unit to produce 1 pound of copper would not change just because the price of copper is going up. It's pure margin. So if we're bullish on copper, you almost have to be bullish on the copper miners. Now, I prefer the copper miners over just copper in general because copper miners have cash flows which they can then use to give you dividends or buy back shares. If you are interested in this sector or in this commodity, I do strongly advise you to listen to some of the conference calls from some of the miners. You get a lot of good information from that. Okay, let's look at S&P 500. It is quite the run up the side of the chart, isn't it? Forward 4-quarter operating earnings 227.60, closing SPX 45.36. Let's call it a 20 times forward on operating earnings. If we use the as reported or the forecast for GAAP 207.69, that is almost 22 times. These are not forward multiples for a 5% quantitative tightening environment. This is more of a sub 1% quantitative easing environment with those multiples. I just can't get on board with these multiples. And I think that is, I'll tell you this. One of the hardest things for me is to be behavioral. I'm very fundamentally driven, but markets can behave differently than the fundamentals. And that's the whole basis of momentum, is it is a behavioral trade. It's not a fundamental trade, it's purely behavioral. I just can't get on board a behaviorally run market. Now, that is, I think, to my detriment, because you're not making money when the market is behaving behaviorally. Warren Buffett is the same way. In the late 90s, he didn't get involved in the tech sector at all, and he got criticized for that a lot, that he just wasn't getting on board the new economy. He got called a dinosaur, etc., but that just wasn't his style. And yeah, he could have made a lot of money had he just jumped in on it, but that just wasn't his style. In the end, it proved that, his style won out in the end. I'm the same way, as I just can't get involved in something that I just don't believe in, and because of that, I do miss the opportunity to ride that behavioralism. It's just not my style. So I could probably benefit a lot if I had an investing partner where I had the fundamental and they had the behavioral, and they overrode my fundamental ideas for a while, and jumped on board the behavioralism. I can't do it. Anyways, I just don't think that these are the multiples for the environment that we're in. And I think phase 2, remember phase 1 is the rates going up. I think phase 2 looks like this. And the longer phase 2 looks like that, the more it's going to weigh on earnings, and you're going to get over time, you're going to get that on earnings. So I maintained my short position, but I changed the composition of it, and I pretty much had to, because market's going up, and I sell puts to sort of hedge against that by lowering the amount of delta that I have. But because of convexity, my short positions are going up linearly, but my puts have convexity such that they work less and less and less as the market goes up. So I flipped it around, and instead of being short puts, I went long puts. So I offset all my in-cash options with short ES. So in other words, I took all the profit from all the in-cash puts, and then I took losses on my ES to equal my gains, so that I have zero loss, zero gain on everything that I closed. I have a much smaller short position on ES. And then I replaced all of that delta by buying puts. I bought the 60 September 15th 45.70 puts at 80.25 with the September underlying, not the December underlying. So what I'm going to do with those is I eventually want them free. I just don't have a lot of time to get them free because it's July now. You've got less than 60 days to get them for free. So I'm not going to wait very long. We're in the middle of earnings season, so I'm going to wait for the market to tell me what to do. And if the market rallies on earnings, I will step into a short risk reversal at 4,700, which means I'll look to sell the 4,700 calls on ES. And if earnings this week are weak and the market drops, depending on how much it drops, I'm going to look to try to get the 4,300 put. Either the 44 or the 43. I much prefer the 43 put to create a bear spread, but if I get the 44s, that's fine. That's 170 points on the downside from 45.70. So I'm just going to wait for the market to tell me which option I want at this point. When I do take them, it'll be for 50%. Meaning that I bought these for 80.25. If we have a rally, I'll look at the 4700s, and when they get to 40, I'll sell the 40s against these to lower my cost by half. If we do get a sell-off, I'll look to the 44s or even the 43s and try to get them for 40. If I can see the 44s at 80, if we do have like 150 point sell-off, if we do have some sort of mild correction next week, because earnings haven't come in screamingly great. The banks, the big banks did well. The regionals not so well year over year. What boosted the regionals was the deposits. Was that they didn't have a runoff on deposits, and they actually had a growth in deposits quarter over quarter. But most of them are forecasting lower net interest income and lower net interest margin on a going forward basis. So it wasn't their earnings that saved them. It was just the fact that, hey, they don't have the runoff in deposits. But earnings haven't really been stellar. They it hasn't been like they're knocking it out of the park. And those that are beating, keep in mind that expectations were lowered as well. This 227.60 is lower than last week. I've heard estimates of 225, and S&P is at 227.60, so I'm not sure which one to use. I think they change. They probably change every day as earnings come out. Analysts update their guidance going forward, and that changes it on a day-to-day basis. So it could be that we have that the 227.60 we're looking at a lag. So that's what I'm going to do. I've maintained the same delta. I've just changed how I got it. I went from being short options, and short puts, and short ES, to canceling it as much as I can without taking a loss. I have a much lower ES position, and then I re-added that delta by buying 60 puts. When you're short a put, you're short a put. A put has negative delta. Negative on that one gives you positive delta to offset against the negative that you have here. So when you lower your negative delta, you have to find a way to raise it again. When you're long a put, you're long negative delta. That gives you your negative delta. So that's how I get back to the same delta position I had before with a different convexity profile. I just wanted to change the convexity profile so that every point up hurts less and less, not hurts more and more. And that's what I have now. And I will step into either a risk reversal at 47 or a bear spread at 43. And if it's just not giving it to me, I may look to 44. I'm not going to wait too long because this stuff decays, right? That's all time value. So that's going to decay. And I probably have maybe 3 weeks before the decay really starts to increase rapidly. So I'm going to do something at some point, and if nothing really much happens, if we seem to have sideways movement, I will take a call for 40, and I will take a put for 40. I'll sell a call and I'll sell a put on these for 40 each, and move out that way. So a logical question at this point: why not just cancel the short position altogether? I mean, if you've reduced your delta that much, why not just cancel it and go long? That would be me responding to price instead of responding to the fundamentals. Now, I have heard this from numerous sources on Bloomberg and even on YouTube, of people a month ago saying that this is not sustainable. There's going to be a correction. We can't keep going in this direction. To this week, they're saying we're going on to print new highs. This is a new bull market. That they've allowed the price to change their view of the economy. In a moment, I'll show you the leading economic indicators. They pointed negative for yet another month. Curve inversions, leading economic indicators pointing down, elevated interest rates, quantitative tightening, unemployment at a 50-year low. Where is growth going to come from? If we think that earnings are going to really accelerate, that what's happened is that the multiple has expanded now in anticipation of earnings really accelerating, where's that acceleration going to come from when everyone has a job? When aggregate incomes are at a peak, where is it going to come from? aggregate incomes are where they are and everyone's spending, and this is where we are. Where's that acceleration going to come from? And I know that there's some people out there saying AI, it's going to come from AI. Well, not yet. Not yet. So number one, I'm not going to bend to changing prices. If the fundamentals begin to change, then I'll bend to changing fundamentals. If I see that there's capacity for growth in the economy, then I will change and say there's capacity for earnings growth in the economy, but I don't see that. So I'm not going to be one of these people that, when the market is dropping, I'm screaming bearish comments, and when the market is rising, I'm screaming bullish comments. I will scream bullish comments when the future looks bullish, and right now I just don't see it. Number two, the reason I still am maintaining the short is because it allows me to be long on other stocks longer than I normally would. In other words, larger positions and more of them than I normally would. So for Freeport, for example, what I plan to do is on any weakness, I plan to sell in the money puts 50 to 100 at a time. Because I do want to accumulate FCX at this point in time. Not that excited about the home builders, but I am excited about the copper miners. So COPX and FCX are going to be the big plays for me. That if I didn't have the short position, I'd be a little bit more conservative. So it does allow me to grab more of that because I do have this hedge in place. That if I didn't have the short position, I'd be grabbing less. So in my mind, it kind of is a wash on that point. So that's why I don't just cancel it, because I believe firmly that I'm correct, that I'm right. And if I canceled it and started singing the bullish song just to see the market do what I think it's going to do anyways, I would look rather foolish. So I'd rather be wrong than foolish. And that's why I'm not canceling my short position. But let me say this. You must do what's right for you. I've said this quite a few times when I do these things. Don't copy me because you don't know what other positions I have. That this is not a single position I have and I'm making a single trade. Quite a bit of this trade is hedge against other long positions. So it's not as if I'm doing this one thing. I'm doing many things that this then is a macro hedge on a lot of other things. So don't copy me unless you have a portfolio like mine and you truly, truly believe what I believe and you have the ability to hold and the ability to handle it moving against you. If you don't, do not copy me. Okay, before we get to earnings, I said I'd put this up here. U.S. leading indicators. This was released Thursday, July 20th. LEI for the U.S. fell further in June. LEI for U.S. declined 0.7% in June 23 to 106.1, following a decline of 0.6% in May. LEI is down 4.2% over the 6-month period between December 22 and June 23, a steeper rate of decline than its 3.8% contraction over the previous 6 months. We don't have to read this part. Let's just read the last sentence. Taken together, June's data suggests economic activity will continue to decelerate in the months ahead. We forecast that the U.S. economy is likely to be in recession from Q3 2023, we're in Q3 now, to Q1 2024. Elevated prices, tighter monetary policy, harder to get credit, reduced government spending are poised to dampen economic growth further. Let's see, there we are, way down here. Now, you do have a little, it looks like a bounce up here, but remember, this is negative, followed by a negative, followed by a negative. These are all contractions, right? If expansions would be above the zero line. If it printed up here, then that is the leading indicators expanding. These are all still contracting. It's just when you see this little bump up on down here, that means the next month contracted as well, but contracted at a slower rate than the month before, but still contracted. Okay, big week in earnings this week. You have 168 issuers. and if you click on the last tab of the spreadsheet forward schedule, it'll give you in order Tuesday after the close, Wednesday after the close, etc. who is reporting. So Monday, not much going on the open. Monday after the close, you have a few, but it really starts Tuesday morning is when you have much more volume. This is interesting to see what the risk events are, before and after. But if you're looking for particular companies, I always sort them by the sector that they're in. So you can just look at the sector that you're interested in to see who is reporting. Look at this. You got Tuesday after the close, you've got Google. Wednesday after the close, you have Meta. You have some big providers here, AT&T and Verizon as well. General Motors, Tuesday. Ford, Thursday. And you have two home builders in here, NVR and Pulte. Going into Wednesday, Lamb Weston, consumer staples. If you've watched Lamb Weston over the last year and a half, they went straight up all through the rate hiking cycle. They did not go down. They went up. Incredible company. Exxon, I want to hear what they have to say. They've already warned based on natural gas. So I want to see what their earnings are going to look like. That may give me some good opportunity with Oxy, that if Exxon is weak on earnings, Oxy would be expected to follow suit because they have a natural gas component in their revenue as well. That would give me a nice opportunity to sell some puts. So you can see exactly what industry you're looking for just by looking down here. So financials, it's mostly a lot of insurance that's reporting that week. Healthcare, I don't really get too involved in healthcare, but some people are. In the industrials, information technology, ServiceNow, Microsoft, Texas Instrument, Intel, anything semiconductor related is going to be watched very carefully. I think this is a misprint. First Solar, semiconductors. Unless they've changed their line of business, I thought they were a solar company. I think that is a misprint in there. Digital Realty, part of the AI. This is data center and REITs, part of the AI play. Let's see what they have to say. And Weyerhaeuser, they're a timber REIT with Canada on fire. A record number now, like something over 10 million hectares have been burnt with that going on. Let's see what they have to say. Lots of earnings coming up this week, and then next week, big week for earnings as well. One more screen before we go. I'm going to each week put a screen of this up, notables. These are headlines that I've come across that I find interesting. I think that we can spend less time on rates. Not as important as they were 6 months ago. Still important, but with yield volatility expected to drop, with phase 2 of the cycle coming in, which I think will be just elevated rates for longer. I think jobs are going to become more important than inflation. So the screens will change to reflect that, and the amount of time I spend on topics will change as well. But each week I think I'll put a screen of this up of interesting headlines and what they may possibly mean. Number one, ECB requests weekly liquidity reports from banks beginning in September. Currently, it's monthly. And the ECB has signaled its intent to continue to raise rates. So, it's one of two things here. Either they see something, or they're aware of something, or concerned about something that the market hasn't picked up on yet. Or they saw Silicon Valley Bank in the US and they're saying, listen, let's not repeat that here. How we avoid that is information. Let's get more timely information. But we know that they're going to continue to raise rates. I find it interesting that they have now requesting weekly liquidity reports from their banks beginning in September. The next two headlines are sort of related. I had found this one first, number 2, and then Ford announced that it was cutting F-150 pricing, and it sort of fit. EV inventories are piling up with dealers. 2 explanations have been offered for this. I think it's a combination of the 2. I'm just not sure what weighting to put on them. I'm not sure if it's, 60% this argument, 40% that argument, or what. Improved supply chains. So you are getting increased cancellations. Consumers were, when they couldn't get anything, were saying, well, I'll order a Rivian, I'll order a Tesla, I'll order a Ford, I'll order something else, and I'll just take the first one that comes in. And when supply channels were tighter and things weren't moving as well, you could take delivery of one and cancel the other ones, and the other ones might not have even been in the supply channel yet, or there was another customer that the producers could easily sell it to. Well, if you have improved supply chains, that means this stuff is flowing through much quicker. By the time you take delivery one and cancel, these are probably already in the pipeline on their way somewhere. So you would get inventories piling up. The other argument is that we're probably at the end of the early adopters, and EV is just not ready yet for mass adoption. So that in demand is starting to drop off because the early adopters are done, but the mass adoption growth in demand hasn't yet started. So you would expect to see inventory builds, and because you see inventory builds, given high levels of interest rates, carrying costs on inventory is going to be expensive. You would expect to see pricing cuts as well. So Ford cut its F-150 pricing. Now Ford has said that it cut its pricing because its input costs have decreased. So if its input costs have decreased to keep the same gross margin, we can lower our selling price. But last quarter, they had said that they can sell every F-150 they make, that they'd like to be able to increase production. They can sell every single F-150 they can make. Well, if you can, why lower the price? Why would you need to lower the price if you can sell every single one you make? Others have pointed out that it's kind of suspicious that the price cut comes as the Cybertruck starts delivery. And 2,000 of these are expected to be delivered in the second half of this year before production ramps up in 2024. F-150 or Ford cut the price on that one. Now, this is all consistent with demand sitting here, thinking that, well, we're near the end of the early adopters, and that is the extent of demand. But if you add up all the potential supply, that means you take every car company in the world and you say, well, how many EVs can be produced in aggregate? You might have supply over here because everyone has been rushing to produce EVs. Every ICE manufacturer has got an EV line out there and is planning to ramp up production and produce more. And if you are producing for mass adoption at a macro level, but demand is sitting at an early adopter level, what you would get is a buildup of inventories. And if you get a buildup of inventories, you got to lower that price, which means you cannot sell every vehicle you make, because if you could, you wouldn't be reducing those prices. You're reducing those prices to induce mass adoption, which means you're going to have lower margins. They're going to have to live with lower margins. If this is the case, if this is where the industry is, demand sitting at the late early adopter phase, but supply sitting at the early mass adoption phase, you're going to have building inventories, and you're going to have price cuts, price wars in the EV sector. And if that's the case, margins are going to be under pressure. This is from Tesla's last quarterly report here. This is taken right from their presentation. There's their operating margin. And this is for the current year, 9.6% on operating margin. Last year in the quarter it was 14.6, down 493 basis points. Under 10%, which is the history of all competitive industries. is that the margins are squeezed down to industry levels. That you cannot have an industry level operating margins of around 8% and one producer at 30%. Not in an industry like vehicles. Now you can if you have a niche player, but you cannot have a mass adoption player with margins here while the rest of the industry is there. Bringing in a superior technology argument doesn't work either. In that respect, you could argue that, well, Tesla has the superior technology, so that's why they have better margins. People are willing to pay up for that superior technology. Now, if I'm the jury, I'm out on this whole idea of them having superior technology. But let's say that I spot you that. I'll give you the superior technology. Not that I'm agreeing with you. I'm just going to spot you that. You get that. Fine. I won't argue with that. So what? That does not mean that consumers are going to just buy that vehicle. The superior technology doesn't always win. It's the price that wins, not the superior technology. Mac is a far superior operating system than Windows, but the market is a Windows market. A Windows box sells 9 for 1 against a Mac. For every 10 computers sold, 9 are Windows. But Mac's the superior product, yeah. But it's also the pricier product. If we believe that superior technology would win in automobiles, if we believe that, let's go back to 2005, 2006, when EVs really weren't the thing at all, other than just, a conversation piece. Hey, did you hear what some crazy guy's doing in Fremont? If the superior technology was the deciding factor in vehicle purchase, everyone would have been driving BMWs or Mercedes. However, what were the big cars from Ford? The Focus. Chrysler was the Intrepid. These are not technologically superior vehicles. They're cheap. They were cheap vehicles meant for a mass market with very thin margins. Cheap vehicles meant for a mass market with thin margins. If you're going to go from early adopters to mass adoption, you have to make a car for that market. And that car is going to be cheap, technologically inferior, with thin margins. If you are going to make a car with superior technology, you're going to be the BMW or the Mercedes of electric vehicles. You are not making mass-produced vehicles. You're a niche player. A profitable niche player, nonetheless, but a niche player. So I don't know which one it is. I don't know where to put the weighting. I think it's too early to tell where to put the weighting on this one. But I don't see margins expanding from here. Either they stay the same or they contract even more. I don't see pricing in any of the car companies with pricing power on their EV side at this point. So I would expect more price cuts and more margin contraction on a going forward basis. There we are.